Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey everybody, this is David Blake, and this is Tuesday Tech Talk. We're going to kind of go over the market. Had a pretty volatile start to the week. Go over some of the resistance and support areas, look at a couple of the sectors that are leading and lagging, and just kind of get a picture of where we're going now. Last week, the markets were lower across the board. The Dow and S&P 500 were both down about 1.3%. Nasdaq definitely underperformed on weakness in technology and biotech stocks, especially the big cap names, and it was down almost 3%, 2.7%. And although breadth was positive on the NYSE, the AD line punched at a new high, which we're going to talk about in a little bit later. But the breadth on the Nasdaq was mixed, and the AD line it was lower, and we still had the 52-week new highs barely beating out the new lows. So that's still a little bit of a red flag, a little bit of negative divergence. The CTI and our market posture remained bearish. The CTI will slip to a -10 on Friday after the close, and it'll still stay bearish for a couple more weeks. So look at this stage probably around the end of May. Of course, that can always be extended if the market continues to put in new lower intraday lows. So we'll keep an eye on that, but we're targeting a few more weeks of sideways to down market at this stage. Our leveraged CTI leveraged 3-to-1 calls in the Dow and stuff. They're about even. I think you're down about 1% tops since we've had them. So we're right about the point where we can start making money on those anyway. Okay, a couple other things that happened last week. Although a lot of analysts are talking about the heavy short position on the market, what I get from the NYSE is the short position has been falling for almost 2 months. So you're losing some upside, some triggers for this to extend the rally. NYSE short interest fell about 4.2% for the period ending mid-April, and it had fallen 3.9% going into March. So the short positions have been coming off. That's going to help. That's going to be hard for the market to kind of have a stronger rally without big short positions in here. Yesterday, the market was up about 130 points. I think it kind of it was hard to tell why, because we had Puerto Rico defaulting on their bonds. We also had some news that out of, I think, China had some weaker economic data. They also had some weaker economic data today out of China, which didn't do much for that market over there, but it did send the European markets down. I see that the German DAX is down about 2% today. It was kind of interesting. I read somewhere that after Warren Buffett's annual pep rally for the market, the market's been up 7 out of 10 years on that Monday. Unfortunately, 7 out of those 10 years also, whether it's because of May or whatever, the market's finished lower by Friday. So we're kind of on the track for that to maybe make it 8 out of 11 this year. So again, yesterday we chose to ignore the Puerto Rico defaulting on their debt payments yesterday. We also saw a U.S. dollar fall to its lowest level since 12/31/14. Now, you'll hear some people talking about how great that is for the market, especially industrials and international companies, but and also how good it's going to be for commodities going forward. And one of the things about intermarket analysis is it's good to know what's supposed to be happening. Like when the dollar goes down, it's great for internationals. When the dollar goes down, commodities go up, that type of thing. But what you also have to understand and look at is when these couplings fall apart, and that means with dollar falling here and commodities also rolling over, you start to wonder if things might be a little bit different, if there's something else going on. That could also mean, to me, it may be signaling that perhaps the economies are again weakening to the point where they may start talking about even further negative rates, which would be negative. And also, if commodities are going down at the same time, the dollar's going down. Again, that means that maybe the supply and demand characteristic of materials and some of it is outweighing the weakness in the dollar. So you want to keep an eye on that. So first what we're going to do is we're going to look at some of the different indexes, look at the pivot points, see where some of the support areas are at this stage, and then we'll go over some of those sectors. Then we'll open it up to some questions on some individual stocks. Okay, here's the Dow Jones. It fell back below the 21-day moving average for the first time since the 1st of March here last week over here on last Friday. We had a move down. You want to see that we went back above it yesterday, but we're back below that 21-day moving average again. You want to keep an eye on that for the short-term direction of the market. We've got our pivot point down here around 17,808, which is right where we are. We're actually below the pivot point. We've talked about pivot points a few weeks ago. That is kind of the level where traders actually kind of think that the trend is actually changing. And trading below that 17,808 is going to open the door to the first support area of 17,453, which actually kind of comes into play right over here where the 50-day moving average is. So, we had a lower low here as the month started in April. Keep an eye on that low. If that gets broken, you're probably looking at further weakness down here, which could bring into play the 50% retracement level of this whole move up from the lows. So, with that area right now, if we get down there, we're going to see the 100 and 200-day moving average. That's pretty good support in this area. And that also, like I say, is about the 50% retracement level. So on the downside, to me, it looks like we could probably, try to find support down here around this 17.1 area. If it breaks that, well, that's something else is going. But you have a lot of negative divergence in the indicators. The 30-day stochastic that I like actually went down to the 50 to cross over to give a sell on Friday. Bounced off that yesterday. I wouldn't be surprised to see us break that 50 level there today, which would mean that the trend has changed to a negative. You also have a negative signal on the MACD, and the RSI is also weaker in there. So we want to keep an eye on that. Now, this is something that I consider a leading indicator for the market, and this is the NYSE advanced decline line. As you can see it on this, we punched out new all-time highs on this thing. But there is an issue that I wanted to talk about. One of the people that I follow is Lowry Research out of Florida. They do great work for institutional clients and have a lot of targets and stuff that they use and sector work. But what this represents right here that we're looking at is called an all-issue AD line. And what's important to know about that is that common stocks, basically public companies, make up about 52 to 55% of the shares traded right now in the NYSE. And this line includes closed-end funds, REITs, preferred stocks, and when you have this negative interest rates and zero interest rates, what I think is you're seeing this going up like this is because you're seeing an awful lot of buying into some preferreds. You're seeing the Treasuries yields coming back down again, and REITs have been moving up a little bit too. But if you look at the what they call the OCO AD line, and Lowry calls this operating companies only. According to Lowry, that line is far below the highs from May of last year, and in fact, the Nasdaq is actually about 34% below the highs from last year when you look at the OCO AD line. So this may be a little bit misleading at this point with the interest rates so low. If interest rates were a little bit higher, I think you would see this thing definitely be coming down. But as a leading indicator, you still want to watch that. But in this case, I think it's a little bit misconstrued. Here's the S&P 500. Just like the Dow Jones, it broke below the 21-day moving average. We have a pivot point on here at 2070, which is right over here, and we broke below that today. Around that 2062 area, something like that, is something you want to watch. 2057 was the low, I think, is where we're at right now. So we're below the pivot point. Again, that's where traders start to look to put on trades to the downside. So first support is going to be around 2029. That also is where the 200 Actually, the 50-day comes into play just below that, and the 200-day moving average is just over here around 2020. So the pullback, if it takes out this low from the 1st of April, that would be our next test. If it breaks that, you could be going down here to the 50-day or 50% retracement of that whole move up, and that's around 1960. So we'll want to watch that. Again, on the stochastic 30-day, we bounced off that 50 level. We'll see if it breaks it down, breaks below that over the next couple of days. If it does, you're probably going down in this area over here at least. Here's the Nasdaq. It's like we talked before. It's been underperforming. And again, the Nasdaq never made it up to this descending trend line from the old highs back to the last fall's highs. It came up short on that. Actually, the S&P 500 came up by about 5 points short of it. And what that actually is telling us, technically, these indexes are still in the process of making lower highs and lower lows. So on the major trend, you have that means that the major trend is still down despite the rally that we've had off of these lows. Technical indicators for the Nasdaq are all basically negative, and even the long-term MACD, which is the good intermediate term trend identifier, I would expect to see this give a sell here over the next day or so. 14-day RSI is below 30 or right at 30. That's also a negative. If we're still in a bull trend, that should stay above 40. So again, the Nasdaq underperforming in here. Today we are at right around 47.55. So we pretty much retraced about 38.2% on the Fibonacci retracement level of that whole move up from the February lows. You could see this thing come in around 4,600. In fact, the first support on the pivot numbers, the pivot number is 48.28 on that, so we're below that. First support would be 46.87, which is right around here, right at this area, and then the second pivot would be 4,600, and that actually also comes into play as that's the 50% retracement level on that move up. So we want to keep an eye on that as far as a downside target. All right, now here's the Nasdaq advanced decline line that we talked about. Again, you can see we're still way below the highs that were made back in December. Never made it up even to the late January, December highs. If you see this thing fall back below this level, that just means that you're seeing much more broad-based selling on this thing. Now, one thing I looked at today that we haven't talked about before, there's something in the market they call 90-90 days, or just a 90% day. And when you've had a 90% day is when you have at least 90% of the volume is either up or in advancing issues or declining issues. And right before we came on here, I took a look at on the Dow, NYSE, and we're at an 88% declining. 80% of the volume today is on declining issues. When you have after a market move, you're kind of going sideways, and you get a 90% volume day to the downside of the upside. What you want to usually is telling you that the institutions are kind of having a change of mind on what's going on here. In other words, they're getting rid of it now. On a 90% day, if it happened over here, that would be a sell-off bottom. But when you're, like say the market's over here and you're getting a 90% day on a declining volume, that's pretty much a red flag that the institutions are saying that we want to get out and watch for a while. So with the seasonally weak period in May anyway, and now you're having a 90% day, all the indicators are giving us negative divergence. To me, it's pretty plain that we're going to probably go lower for the next couple of weeks. And I would be I get a lot of emails, what should we be looking to buy? I'm not really looking to buy anything, maybe gold or something like that at this stage. So take a look at that. The next one we're going to look at is the Russell 2000. Again, the Russell 2000, we're back in the, we actually made it above the descending trend line briefly, came off here, tried to bounce off of it, and now we've broken that. So, but we're still in a period here of lower highs and lower lows. That means the major trend is down. So we want to watch that. We're breaking below the 21-day moving average on the Russell 2000 too. A pivot point on this is 1125. We are at 1117 right now, so we've broken below the pivot area on the Russell 2000. First support would be 1094, which is right here, right around the 50-day, and then the second support would be 1057, which is somewhere down in here where we're about halfway up of this rally. So maybe a 50% retracement would be it. I don't really think that we're going to see things break that. We'll look at that again, but at this stage, that would be my primary target, would be the 50% retracement on a lot of these. Okay, the next one is the Dow Jones Transportation, which we talked about the strength in that. The transports kind of let us down. This is a 2-year chart. You saw how the transports let us down. The Dow, I think, and S&P made a new high right around here. So it rolled over first. It bounced off in January. It made its low, and it's going to just come up. But as you can see, it's not quite as strong as what everybody believes. This is a heck of a move up here, but it's still in the process of a lower high and a lower low over here. This thing rolls over. The indicators are all turning negative on this, and it's fallen below the 50% retracement level of this whole move down at this stage. So we got support down here at 7,800. Today we're at 7,784. So we're breaking below some key major support areas with the 50 and 200-day moving average. Next support level is probably down here around 7,400. Actually, 7614 is the next level down here, which would be these lows from the, I guess that's around the 1st of April. So we want to see if it can hold that. If it doesn't hold that, then you're probably going down here to the 7,400, which represents a 61.8%. And that's a very key point, because usually when a stock falls back below this 61.8% Fibonacci level, retracement level, it usually means it's going to retrace the whole thing. I think it will find support in this area, but if we don't, that's a break below 7,400 would be a real red flag for the broader index. Okay, before we go on and look at a couple of sectors, what I wanted to look at first is gold. This is actually just GLD, which is an ETF, which is an easier way to play the gold market. Yesterday we actually touched on 1,300, which was the first time in, I'm not sure exactly how long, 8 to 18 months or something like that. But you can see the actual breakout of this over here. Today we're kind of congesting it a little bit again. But you also had a breakout not only in price, but you're also getting a breakout on the different indicators over here, which is very bullish. Now, if you look at a longer-term chart, this is going back to the beginning of the financial crisis, where when we were looking at where things were getting bad, you had a big spike up in this. And then we've kind of, as the economy kind of started to show some traction, it started to fall back. Okay, now we've broken above this descending trend line, just going back to here. And we've retraced 38.2% of this move from here to here. What this is going to set up for is probably a run up here on the GLD to about, let's see, probably around 1360 on that. As far as the actual gold itself, this is going to probably translate to a target of around 1425 to 1450 on gold. Lots of reasons to think that'll make it. Number one, just the global economy is having trouble. People are losing faith in the central banks being able to stimulate any kind of stimulus or kind of any growth here. And we're not sure how the negative interest rates are going to work out. And if you think our election process going forward in the fall is not going to have some wild times going forward, I think you're missing the boat. So I think all that will tend to put a bottom under gold, and I think you can actually, even if you want to wait for a pullback, you could do that. You may not get much of a pullback, but I think maybe gold in here certainly has, for a defensive position, would be something to consider. Okay, this is the U.S. dollar. We talked about that falling yesterday. And fell yesterday. It's down a little bit again. Actually, today it's kind of flat. But you've broken out of a multi-year support, say, where you were in a trend line and you in a trading range. I mean, you've broken below that. At the same time you're breaking below that, you're getting a sell-off in the commodities over the last couple of days. Today, the energy sector is down almost 3% today, 2.85. Oil's down over 3%. Materials down over 2%. And financials are down almost 2% today too. But this is a problem. And like I say, when you can get these guys on TV, they're going to tell you that this is great for the industrials and stuff. But when you have the dollar falling like this, and you don't see the commodities rallying and the international markets and stocks rallying with it, that's a big red flag. That means the coupling of the weaker dollar with the stocks is changing, and you want to watch to see if that what happens. Now, if this thing goes here and all of a sudden the commodities start going back up, well then, okay, the coupling's back in play. But when the things aren't working the way they're supposed to, you have to stop and pause and try to figure out why it's not working. So we want to keep an eye on that. Here's the longer term view on the U.S. dollar. This is the ETF UUP. Again, you can see here we broke below this move from back here mid 2014 to the high in 2015. And now you've broken the 38.2% retracement on that whole move. You're down here. You're trying to your next support level is down here around 2380 or something like that. Keep an eye on that because that's the 50% retracement level. And this thing starts breaking down. I'm not sure what that would do for the market, but I don't think at this point it's good, especially if the commodities keep on breaking down. So it's kind of almost have a little bit of a collapse in the dollar, which you want to keep an eye on. I think to me, it's kind of signaling that investors are kind of losing faith in the central banks in general. That's not a good sign there, but it could be good for dollars. So that's just a couple of charts to look at before we go to these sectors. Okay, now this is another one I put up here. This is the dollar versus gold. As you can see here, when the dollar was strengthening, we had the weakness over here. Okay, now we're having this pullback in the dollar, and you're having gold take off at the same time that the dollar is collapsing. So that's just, as you see this dollar weakening, that's just another reason for you to maybe put some gold into your portfolio. Okay, I want to look at just a few of the sectors real quick before I run out of time. Okay, over the last couple of weeks, what's been leading the market down has been technology, healthcare, and the financials, especially the last week or so with the financials. As far as the tech spiders goes, you can see that, I'm not sure what that is, but you can see this thing has rolled over, got up here, had a 1-2, kind of almost a quadruple top or double top, whatever you want to call this. We've rolled over here, retraced part of the move on here to 42. You're trying to find support on the tech sector, which is XLK. If you follow that ETF, we're down 1% today to 41.87. So you've broken below the 200-day and 100-day moving average in this area. Next support on that will come in here around 40.60 or so, and that would represent this area over here. So you want to watch to see if that's where that's going to lead us. The healthcare spider has done fairly well, except the biotechs have just been crushing on this. It fell below the 200-day moving average over here. $69 is where the 38%, the 38.2% retracement level is of this whole move going up here. That's also where the 50-day and 100-day moving averages are. So that's pretty big support over here. That's also where it kind of had some resistance back here on this first run. You want to make sure to see if that holds. The indicators are showing negative divergence. But if it can hold down around this area, this 50% level or so, this might be around the area that you might want to start looking at some of these biotechs that have been crushed, and if the market kind of firms up. I would probably hold off on the biotechs until you see this thing try to hold around this 100-day and 50-day moving average on this. Okay, the next one we're going to look at, that's really been, this doesn't really look weak here, but we've had a couple bad periods right in here over the last couple of days especially, and I would be starting to think about lightening up on the financials again here just after this move here. We lightened up on them over here, then we got this spring over here. You're starting to see a rollover in the technical indicators. It fell below the 200-day moving average today. Next support level will be around this 2240 level, which is a 38.2 Fibonacci area. That also is where the 50 and 100-day moving averages come in. But it seems that today it's also one of the weaker sectors with the energy and materials. As far as what's strong, not that I'm looking to buy anything of this thing, but here's the consumer staples. XLP is in Paul is the symbol for this, and this is the defensive sector. It looks pretty good, but you're kind of in a trading range that looks to be going negative here. If you don't break above this thing, you may come back down here and test the bottom part of this trading range. My only problem with this is it's expensive. I mean, you're looking at you're buying into stocks like Procter and Gamble and Colgate, this type of thing that normally trade at about a 12.5 to 13%, or not percent, but PE, and we're trading up here around 21, 22, 23 times earnings, which tells me that people are buying them because of the yields. But I just don't think that's the real reason. The reason you want to be buying these things and chasing them higher, if it's just because of a yield, you might be able to find yield something else. Okay, the last one we're going to look at is the energy spider. We've had a heck of a move off of this thing, off of these lows back here in when oil bottomed out here. I think it was January. And so far we've covered up most of the moving averages, but we are struggling here at this 38.2% retracement of this move down from when we rolled over. So if we can roll through that, I think you could get through this. But we're having a little bit of problems in here. Again, you want to see whether or not if we're at $43, I believe, on crude oil right now. If we break below 43, there's going to be a lot of people watching $40, and if that breaks, you can see people taking money off the table because they've made double or triple some of these oil stocks, and they're not going to let that thing fall all the way back down. And again, if we're not rallying on a crude oil on a weak dollar, then that may be telling you that the supply and demand characteristics are going to come in, and you're going to want to watch that. So that is there. I had a couple questions came in which we covered on gold and stuff during the week. Someone asked me to take a look at Cabot Oil and Gas. Take a look at that chart, and then we'll open it up to the questions. See, we got a bunch of them today. But Cabot Oil and Gas has had a rally with all the energy stocks, kind of trading sideways over here. It's walking up the 21-day moving average, which is good. If maybe running out of momentum with this, we kind of want to watch this area fall below like 23 or 22 and change might be a little bit bothersome. And you can see over here the indicators are kind of neutral on this stock. So unless the whole market turns around, I would probably be very cautious on putting new money to this. I would probably be more inclined to, if oil keeps going down, to maybe look at taking a profit on this thing if it falls below the 21-day moving average, somewhere around that. Last one I had a question on individual stocks was Ford. This looks pretty good to me. We had a little bit of a pullback here, and then it took off again. Auto sales seem to be strong. We broke above the 200-day moving average, fell back below it today, but the indicators are a little bit mixed. It's struggling. We need to get it back above the 200-day. That would signal a little bit more upside. But your upside of this thing looks to me like you could hit about $16. And the reason why, if you remember a couple of weeks ago, we talked about point and figure charts to look at breakouts. Here we are over here. If you can see this thing come up here, and we can probably get a resistance is going to come in up here at the $16 level. We can break that. You might get another one up to 17. So Ford would be one that if you like the overall market, I think you could look at moving into that. Okay, I'm going to close this thing down, and we're going to try to share the charts over here because I think we've got a bunch of questions, so I'll try to do this real fast. Okay, let's see. I don't have any video. There's supposed to be video. I have video. Okay. Okay. All right, S&P 500 and Dow Jones look to be in a W pattern. Double bottom reversal trend not holding up. Okay, let's look over here at the chart on that. They obviously put in a double a double bottom. That's a W pattern. You can actually take a target if you actually go from here to here to there and add that up. That would have given you the target right over in here to the upside on the Dow. But again, that's you of course you bought the W pattern. That's great. But now we've gotten up to the point here where we're overextended, and on the other indexes, you never made it up to this point here, and now you're starting to roll over with the indicators going negative. Negative divergence down here on a 14-day RSI. If you look over here, even the Russell 2000, that's not a W pattern, but again, we looked at it before. You didn't make it up to this. You're having trouble up here with the ascending trend line. You're still at a lower high and a lower low, so we want to keep an eye on that. To me, the major trend is still bearish on those. Okay. Okay, I bought all the CTI shorts. It seems like SQQQ has outperformed the three others. Others are flat. Any explanation? No. What my explanation is on that is why you buy all of them. In fact, I think on the leverage when you're up about 7%, I think including today 7 or 8% on the QQQs. With the Dow and the S&P, you're just a little bit. You're down like 1% or something like that. But the Russell 2000 over here had a pretty good spurt after we went to the sell on the CTI. That's keeping you basically. If you bought all four of them, you're at I think you're down 1.25% today. So not too bad again. But I'm looking at the weakness should expand out through the next for the next couple of weeks. I wouldn't be trying to jump in here on these weekdays. I think you'll end up probably making some decent money on that. I would hold. And again, when the CTI goes negative, it doesn't mean we're crashing like that, but it just means we're expecting a weak part of the market. Again, you got the seasonal plays also in the with May coming in here. The market letter yesterday came out with a sell in May, and I think that's probably the way you want to play this and stay on the sidelines. Until then. Okay, utilities for the summer. Yeah, they're not cheap, but you're looking for a little bit of yield. Going over here, look at the utility index. You're not at an all-time high, but you're close. And again, you're getting a little buy over here. You might be able to get some more upside. I wouldn't be buying this for big gains. I would just be buying utilities for defensive move on the whole market. And once things kind of settle down, you might look to go to get it. But utilities look fine in here, but they're also expensive. I mean, you're looking at paying 20 times earnings for utilities, which historically has not been the best thing to do. But as long as rates are zero or lower, you're fine. Once they start hinting at raising rates again, though, and I think it was the guy from Atlanta. Name, the Fed president from Atlanta here, he actually came out today and said that a rate hike in June is a real possibility again. Every day you can get one of these Fed presidents coming in and refuting what the other ones say. So they're not adding any confidence to the central bank either when they contradict each other from day to day about what the Federal Reserve's plan is. So again, as long as you have zero interest rates. These high-yielding things are fine until the first time they say we're going to bump it, and then they get hit pretty quickly. Okay, went about 35 minutes. I don't see any more questions coming up, so we'll wrap it up with that. Again, I would be very cautious. We still have bearish market posture, and we'll see what happens the rest of the week. And I will talk to you next week. And thanks for joining me today. Thank you.